U.S. natural gas futures rose toward $3.33, closing in on their highest level since January, driven by reduced domestic gas production and increased exports. Short-term weather forecasts further supported the bullish sentiment. A weather system is expected to move across the Midwest, bringing cooler temperatures that could increase heating demand. Weather analysts predict that highs will range from the 40s to the 60s in the Midwest, eventually shifting towards the east. However, the biggest reason for yesterday's huge spike was a massive bullish EIA weekly storage report miss, since it implied what was once looking like 2 to 3 builds near 100 BCF. The shoulder season will now more likely be zero. EIA data revealed a smaller than expected storage build of 86 billion cubic feet for the week ending September 29. The market had forecasted a 92 billion cubic feet build, making the actual figure a bullish surprise that may have caught new short positions off guard. Additionally, the Cove Point LNG export plant, which halted operations around September 20, is expected to resume production within the next week or so. Elsewhere, workers at U.S. energy firm Chevron's 2 LNG export plants in Western Australia voted to restart strikes. Reuters reported on Thursday the bulk of workers at the facilities had voted to strike. Chevron did not respond to Reuters' requests for comment, but on Thursday said it continued to work with all parties to finalize a deal based on recommendations made by Australia's industrial arbitrator, the Fair Work Commission, in September. Baker Hughes said that puts the total rig count down 143, or 19%, below this time last year. The number of oil rigs in the United States declined by 5 to reach 497 for the current week, marking their lowest count since February 2022. Meanwhile, the count of gas rigs increased by 2, reaching a total of 118. Drillers have cut active rigs for 3 quarters in a row, in a delayed response to the sharp drop in prices since the middle of 2022. While oil production has recovered to pre-pandemic levels, its growth has slowed as it takes on average about 12 months for a change in prices to filter through into a change in output. Shale firms have also tried to eke out extra oil output by concentrating the smaller number of rigs on only the most promising well sites and boring much longer laterals, which boosts productivity per well. Gas output has also continued to grow, also a lagged response to high prices in 2022, and due mostly to increased interest in oil drilling in shale basins that also produce lots of associated gas like the Permian. The subsequent slump in gas prices, however, has been more severe and is causing a more pronounced slowdown in output growth. Given the current market dynamics, especially the bullish EIA report and the cooler weather forecasts, the short-term sentiment for natural gas appears to be bullish. Natural gas rallies after the successful test of the previous resistance at $3. From a daily technical viewpoint, the current daily price of nat gas is trading above both the 200-day moving average of $3.17 and the 50-day moving average of $2.73, indicating bullish momentum. The nearest material resistance level for nat gas is located in the $3.60 to $3.80 range, leaving ample room for further upside momentum. In fact, I would not be surprised at all to see the market move toward the $5 level over the next couple of months. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.